All right, Jerry. Well, glad to finally get you on the podcast. We've been working together for a long time. At this point, you're our most tenured advisor at Beck Capital
Mhm.
Management, and I'm
I love
excited.
that word tenured, by the way. Just makes me feel really old.
Well,
Yeah.
just lots of wisdom,
Yes.
and
I
that
hope so.
wisdom is exactly what I want to share with our audience today. And so, I know today we're really going to talk about that advisor-client relationship, kind of what people should be looking for, whether they're currently working with a financial advisor or looking to work with one.
Mhm.
And so, why don't we start off? You give us a little bit of your background and then, kind of the type of clients that you work with today and how that relationship kind of works for you.
Yeah. So, Beck Capital and I, we go back to 1997 when the firm was started. I actually was working with your father, our founder, Frank Beck, prior to that, in his prior job before he started what then was Capital Financial Group. And boy, there's too long of a story to tell you all the details about that. But suffice it to say, when he made a decision to leave that organization and start his own firm, where he invited me to work with him, he approached me and said, "This is not working out for me here. I'm going to start my own deal. How would you like to join me?" To which I said, Frank, you're the reason that I came here in the first place. So, yes, I absolutely would be interested in joining you. And that's when it all began. Again, back in 1997, long time ago.
Pretty
And
amazing.
second best decision I ever made, next to marrying my wife of 24 years.
I like
And
that.
yeah, and he had a part in that too.
Well, I know that typically a current typical client for you is retiree, but I know you also work with business owners
Yeah.
and high net worth individuals. Does that kind of summarize your clientele for the most part?
Yeah, but pretty much. I would say the majority of my clients are either approaching or nearing or in retirement and are interested in making sure that they have the income needs met once they get into retirement. And we do a very good job of focusing as far as how we serve our clients. The most important thing is what we do up front, and that is by providing the individual, we call it client profile, where we do a deep dive into looking at the individual and what their uh, tolerance is for volatility and risk and what their attitude is towards investing, period, to make sure that we categorize them in the right type of portfolio that, again, with us is individualized and custom tailored to them. And that is the most important thing I think we do in the beginning of the journey with our client is making sure that they're invested appropriately. And by the way, not in the cookie cutter style way, if you will, that I find the majority of people that come in to see us for the first time uh, have employed with we'll talk about this more as we go into the podcast, but um, the classic grouping of mutual funds, where someone else other than the person that chose the mutual funds for that person to invest in is managing the money. So here with our individualized portfolios, again, that are custom tailored to the individual, we're managing the money in-house and we have control not only over the portfolio itself and every security that the client owns, but the tax issues as well. So that's kind of basically how we get started with folks, Victor.
Yeah, I think that's great. And I know that as a part of this broader conversation, talking about that client advisor relationship is, I think, the really important thing that I think we do well, that's important if you're a registered investment advisor, as we are, is that fiduciary relationship.
Hmm.
And so, for those who may be listening who aren't familiar with the term fiduciary, that's that legal obligation to act in the client's best financial interest. And I think that's really where you want to start off from if you're
Yes.
looking for that financial advisor to work with. Is it's really beneficial, not saying that someone who isn't a fiduciary may not
Hmm.
act in your best interest, but working with a fiduciary means that that person, like yourself, is
Hmm.
obligated, legally obligated, to work in the client's best financial interest. So they
Yeah.
always know that you have to have their best interest at
Yeah.
heart.
And that's the key word, right? Legally obligated. So, the actual definition of fiduciary is a person who manages money or property for another individual. And by law, it says they are, as you say, obligated to put their interests before yours. And as a registered investment advisory firm, which we are, and a fee-based firm, it's much easier for us to first cross that very low bar, which is the first one that you need to meet, really, if you're going to make a decision on working with an advisor, is that they are a fiduciary, is to know that um, each quarter the compensation to us is paid via a fee, a flat fee based on the amount of money under management, right? And in the commission-based world, I call it the transaction-based world, that's not the case. So my feeling is, and I'm not trying to throw water on the mutual fund crowd out there, or disparage them. That's a way of doing business. Ours is a different model. And with the transaction-based world, the truth of the matter is people are compensated via what? Transactions. So the more transactions that are implemented, the more that person is compensated. With us, it doesn't matter how many or how few transactions take place. It has nothing to do with our compensation. The only thing that will increase our compensation is your account value going up. And conversely, the only thing that will decrease our compensation will be your account value going down. So we're incentivized every day to make sure that that is what happens, that account value keeps moving north. And the sad truth is, in the commission-based world, after that commission has been paid, where's the incentive? I think it's for the most part over with at that point. So two different approaches, to be sure.
Right. And I think that's important for our listeners to keep in mind when they're looking for that financial advisor relationship, is that how exactly is their advisor or their financial planner or retirement planner getting compensated?
Mhm.
Is it just transactional? Is it a one-time thing where that person's going to sell you a product or give you a service for a limited amount of time and they're going to pay a fee? Or are they going to have this ongoing relationship? I mean, you and I have to earn our keep every single day
Mhm.
because that fee is, prorated throughout the entire year. So if
Mhm.
a client left, that you're only getting paid up until that day where they're working with you.
That's exactly right.
So I think it's important to look at it from that perspective because
Mhm.
one, we've got the fiduciary piece where you're legally obligated to work in the client's best interest. But then two, you've got the fee-based portion where you have the alignment of incentives between the advisor and the client so that you're working together, making sure that value is created every day in that relationship so that the advisor at the end of the day earns their fee and the client it's worth it to the client to pay that
Mhm.
fee. So
I like
I
to
think
say
that's
it's
really
like
important.
we're in the same wagon pulling together, going the same direction, right?
Right. Exactly.
So I wanted to expound a little bit, if I might. We're talking about these two different worlds, but how do we get there? And what is our investment philosophy, right? Because I always say to people when they come in, is can you tell me a little bit about the investment philosophy of the firm you're with now? Because they should know, right? And many times they don't. And when they do have an idea of what that investment philosophy is, invariably it is a some variation of, okay, I'm 60 years old, so they told me that I should probably have 60% of my money in bonds and 40% in equities. Okay, because of your age, there's your allocation model, right? Well, I would say that's interesting. Uh, because the truth of the matter is, over the last few years, we've had a situation where bonds did miserably, quite frankly. And they did so in a time when it was forecasted and predicted, almost guaranteed by the Federal Reserve that you were going to lose money in bonds. Why is that? Well, because what did he say? When he said he was going to break the back of inflation, right? How does he do that? Well, he raises interest rates and he raises them and raises them and raises them a lot. And he even used the word pain. He said, there's going to be a lot of pain. He basically was speaking to the bond market. He's like, hey, listen up. Interest rates are going up. Bond prices are going to fall. So what am I getting at? There's an inverse relationship between interest rates and bond prices. And when interest rates go up, bond prices, meaning the value of those bonds that you hold, is going to be going down. You can almost set your watch by it. I mean, it's going to happen,
Right.
right? And in spite of that, it amazes me, Victor, that there are so many advisors out there that will still stick by this same, tired old model of continuing to throw this large percentage of money into a losing asset category. Now, I want to tell you, during that time frame at Beck Capital, we have not been investing in bonds. That does not mean that we haven't that we don't have, and we do have investments, some very unique and innovative investments, in fact, that bring yield to our clients and do it quite handsomely. So it doesn't mean, and there are various ways which we can talk about if you like our structured notes, which we design in-house, that are bringing high single digit to, in some cases, low double digit leads with significant downside protection to our clients. Our real estate investment trusts, which bring very nice yields on an annual basis. Our dividend paying equities. There's lots of arenas and areas where we get yield for the clients that are absent and outside of the bond realm. So it's kind of sad to me that this is still such a common model or investment philosophy, you will, that people are uh, told to follow, that doesn't always work. And I will just close by saying that for many, many years, decades, in fact, this bond stock ratio I was talking about model worked pretty well. And the reason it worked pretty well is because interest rates have been going down forever. But when the game changes, which it did a couple of years ago, then if you're an astute investment advisor, then you do something about it, and which we did. So just wanted to say a little bit about that.
No, I think you're right on point with all of that. I think that investors, especially those who have accumulated a lot of wealth over a long period of time, shouldn't just accept some cookie cutter portfolio for what, how to manage their entire financial portfolio, all of their financial assets. They should look for someone who's going to give them a sophisticated approach, someone who's going to do things that are customized. And I think that gets us into just this broader conversation about how client dollars should be invested. And I think you made a good point, because whenever a lot of advisors are using this 60-40 approach or 80-20 approach, it's a lot of times done through just mutual funds or ETFs. And I think a big part of what we have to do as advisors is justify the fee that we charge our clients. But a lot of these advisors are charging a similar or even higher fee, but then they're also layering in all of these products, mutual funds, ETFs, and that's all that constitutes that 60-40 portfolio or 80-20 portfolio. And so not only is the client at the end of the day paying the advisor, but they're also paying those mutual fund or ETF fees, which in some cases can be 50 to 100 basis points. So you may be paying your advisor 1% or above 1%, and then paying another 50 to 100 basis points up to another percent for those funds. And so the client, without maybe even knowing it, may be paying up to 2% for the management of their portfolio. And if their advisor is putting them in all these products, they're not the ones doing the management at the end of the day. So if they're going to justify their fee, they better be finding other ways to do it.
You say without even knowing it. And the truth of the matter is, most of the time, they don't. And when I explain to people that the fee that they pay us as their advisor here on $1 million portfolio, it's 1%. It's transparent. You see it on your Fidelity statement, and Fidelity is our third-party custodian. We can talk about that if you like. The importance of why you should have a third-party custodian that clears your transactions and provides your monthly statements where your money is held, all right? And then they act on the execution that we tell them to make on the buys and sells of the securities in your account. But most people don't realize this, Victor, that if you have an advisor that does, as you describe, put a person into a basket of mutual funds, you're paying twice. And the individual, the advisor that may be receiving that same 1% or whatever it might be for making basically one decision. And what is that decision is what basket of mutual funds do I put this client into? And they're done from a management standpoint at that point. They have nothing to do with the decisions on what is bought and sold in the account. Who does? The mutual fund manager. And of course, that's the person who's actually being paid for the management of the account. So let's just do some simple math here. Let's just say the two advisors, one us, one the person that's using the other approach, is paid 1%. When you tack on the national average, by the way, of mutual fund expense fees is 0.70%, 0.7%. So you compare 1.7% to 1%. Where I come from, that's 70% more. That's a lot.
Right.
And we'll talk about this, but in my view, for investment management that is not as good as what is provided with us with our in-house management and the implementation of our investment philosophy, which is extremely effective, which we'll talk about too, I know.
Yeah. And I think going off of that, it's important to have both that strategic investment mindset, but also a tactical mindset as well. And so whenever you're discussing the differences between the mutual fund approach and what we take as an individual line item investment approach, where you have individual equities, a lot of times individual fixed income, individual alternatives, there's fundamental differences between those two. And I think we really touched on the fee perspective, which is a very controllable piece of that.
Yes.
But then the other piece, and I love your saying for this, is, the all things at all times and all in approach that, mutual funds have compared to, the way that we are taking that tactical approach to investing.
So what I say is, out there in the mutual fund world, and it's a way to invest. Okay. I don't want to, beat up on these guys too much, but what I'm about to say is just true. All right. It is. And if that's the way you want to invest, if you want to stay in the mutual fund world, God bless you. I think ours is a better way. But I say it's all in, all things, all the time. All right. Let's take all in first. Recently, we had a 10% pullback. We have very quickly recovered from that. In fact, within less than a month, we're all the way back from where we were from that, recent drawdown, right? Which was really, we call it kind of a one-off because it involved a couple of things. The Japanese carry trade, it's called, where, they were borrowing money in yen and then getting it in dollars and so forth. And then we had the unemployment report that came out that was a little less than stellar. Okay. So the market had a little freak out, right?
Right.
What am I getting at is this, is that if you had a mutual fund portfolio that was selected for you, and that investment advisor put you into a basket of mutual funds, you would be 100% invested on day one. Not very good timing. How did that work out for you? So what we do, we never put our clients' money to work all at once. We feather in, we work our way in, sometimes quicker, sometimes slower, depending on what the current environment is in the market, right? Well, that wasn't a very good environment at that time. And in fact, I can tell you that I have a client that came in exactly at that time that had $1.2 million. No, it's like, I know exactly what it was. It was $1,150,000 at the beginning of August that is now sitting at $1,200,000. So a very nice start. But his money actually got here right at the time that drop took place. But because we were very deliberate, if you will, and slow about putting the man's money to work, not only did he not get hit with the 10% drawdown that folks would have if they had just put everything in mutual funds in day one, because again, you're 100% invested right now, right? So that's why we say that all-in approach is definitely got its flaws to it. All things has to do gets right to the heart of the matter, Victor, of our investment philosophy and why it is so effective versus the other folks and what they're doing. All things simply means this. In a typical mutual fund portfolio, what you see are investments that are categorized mostly by size and not class. Small cap, mid cap, large cap, international bond, and whatever the appropriate mix is, right? But it's not really sector specific. They're just investing in everything. And everything is not good all the time.
Right.
What we're doing is a very sector specific approach. In fact, our investment philosophy is very simple to say, but takes a lot of work by you and others on our team to implement. And that is this: sector rotation and a cash prudent approach when appropriate. Pretty simple, right?
Right.
But identifying what those sectors are that are the right places to be and avoiding those sectors that are bad, in some cases, even toxic, like back in 2008, for example, when we got out of financials, mortgage companies, banks, home builders, everything that had to do with everything within that realm, right? And in fact, your father in 2008 was on CNBC in an appearance where there was a gentleman from Bank of America on the other side of the screen who was pounding the table on why you should buy Bank of America, which had dropped from $60 to $30 a share on its way to $3. Because as Frank, your father, intimated, that you really couldn't quantify what the mortgages within these tranches were worth that this company was holding. And this, in fact, was the big signal that the market gave us, and that is the knowledge that all these subprime non-documentation loans were fixing to reset in 2008. So it's like, oh, light bulb, look out, we got something bad that may be coming here. So what's the point? Is that was a point where we took action and we got out of a sector that was very toxic. So back to the larger point, which is this: money is always flowing somewhere. And if you take a sector specific approach, then you identify those sectors. For right now, I would say two of ours are energy and technology. That have, obviously, if anybody's been following the markets at all, you know that technology's doing superbly well. Well, it's not always that case. So we use the term sector rotation for a reason, because things aren't just static, they're dynamic. They don't stay the same way all the time. And you shouldn't invest in all things all the time. So, and that's the final part, the differentiation between the all things is them investing in everything and ours being sector specific, right?
Right.
But the all the time part speaks to that cash prudent approach that I was just alluding to, of one example of what happened in 2008. And again, we did back in 2000 during the dot-com bubble and tech crash, is that sometimes it's a prudent thing, not all the time. Like this recent drawback that I was just talking about, where we went down 10%, we did not move to a strong cash position because we did not see anything fundamentally different or changed with the strategy that we had that would cause us concern to move to the exits, correct?
Yeah, exactly.
So that's kind of basically why we talk about these three things and what differentiates us, I think, between the competition very clearly, Victor.
Yeah, and that brings us to our broader investment strategy, that 30,000 foot view of the world, where money's flowing, it's always going to flow to where it's treated best. So once we decide on those international geographies, whether it's the United States, emerging markets, some other kind of developed countries' economy,
right,
investing there, and then deciding the sectors in those countries or in those geographies that are going to most benefit from the broader macro environment. And then once you get to those sectors, it's more of the bottom up approach where you're looking at the individual companies, deciding who's got good balance sheets, good cash flows, and then really constructing a nicely diversified portfolio out of what we believe are fundamentally the best companies to own in the best sectors, the best areas of the world.
That was a great explanation. And I couldn't put it better myself. In fact, what you just said talks to the complexities and the work that goes into doing everything that we've been describing. It's a short, one sentence philosophy. It's easy to say, but it takes a lot of work. And that double drill down, I call it, like you were talking about, first identifying the sectors, but then you got to drill down and find out, okay, who are the companies within those sectors that are the best of the best? Because those are the ones that we want to own, right?
Right. Absolutely.
Okay.
And so I think we've touched a lot on the investment management part of the advisor relationship with the client, what they really should be looking for when they're working with a financial advisor, or if they're just thinking about working with a financial advisor. But also, there's a lot more to the job. Obviously, we talked
Mhm.
earlier about earning our keep every single day.
Right.
Financial planning comes into that. Retirement planning, you mentioned working with retirees to cover
Mhm.
income needs. And I think a huge portion of the job is just managing that financial life cycle, managing the goals that our clients have,
Mhm.
translating that first into that portfolio, as you mentioned, but also monitoring that
Yes.
as time goes on. Because, like you said, we are not a set it and forget it kind of
Right.
strategy. It's an ongoing thing. And it's always
Mhm.
a pairing of the technical piece, which may be the investments, with the more personal piece that is the kind of financial planning or retirement planning. And I know that
Mhm.
you work with your clients over time to not only address that investment management piece, but
Mhm.
also to take care of the financial planning piece, and just to be a sounding board for financial advice as you are advising your clients.
Yeah, a couple things I would say on that is that I liken it to when you are going on a long trip and you get on the plane, things can change between now and New York City where you're going to arrive, and the pilot has to make some adjustments, due to turbulence or weather or who knows what's going on, that and if he doesn't make those adjustments, maybe he doesn't end up in New York but somewhere else. So we get together with our clients at least on an annual basis and look at where things are, find out if anything's changed in their life that would cause us to make adjustments to the portfolio in terms of either their risk tolerance or the timing of when they're going to need to take retirement income. And really important though is because people want a roadmap, right? They want to know, am I going to be okay? Am I going to have what I need when I get to retirement? And that's a big part of our job. So we sit down and do a deep and thorough look with the answers actually put on a spreadsheet that we put together that shows here's your assets now, here's your Social Security, here's your pension if you have one, here's what everything adds up to, right? And here's the income need that you told us that you're going to need to get by on. Well, we want to make sure that that client has exactly that, that the income needs that they've been working for all their life, which is what it gives me, I just say, the greatest pleasure in my life. And I love my job so much and who I do it with. I look forward to getting up and going to work every day. And even though I'm 69 years old, maybe another 15 or 20 years, I'll slow down a little bit. I don't know. But for now, everything's great. But I get so much joy out of seeing people's financial dreams come true. That's what I say we are. We're dream makers for people. We help make it a reality.
Yep, absolutely. And I think that part of that process that we didn't really touch on earlier, but I want to make a point of, is really the tax management piece of
Mhm.
one's investments. I think that's where a ton of value can be created from the advisor's perspective and from the investment management side's perspective for that client. And that's where I think a portfolio like ours, or anyone who
Mhm.
holds individual securities, can really benefit from. The client can really benefit, because whenever they're looking to make a large purchase and need to
Mhm.
sell a portion of their portfolio, you can be very selective about which tax lots, which securities you're selling, because some of your portfolio may have appreciated a significant amount,
Yes.
and you may not be looking for a huge tax bill next year. So you may not
Mhm.
want to sell that piece. Well, if you're only in a handful of ETFs or mutual funds, you don't really have a choice. Of course, mutual funds, you can't even control your tax situation, because that tax is being passed through to you actively.
Mhm.
Or you're looking at ETFs where, hey, if I have 4 ETFs in my diversified portfolio, well, they all have gains. I have to sell this and I have to take a tax
Yeah.
hit. Whereas if you have a lot of line items in your portfolio, you have opportunities to potentially capture losses if individual positions happen to be down, or if some aren't up as much as others. You can sell those, use those for your liquidity, so that you can manage that tax situation, because that's a lot of what you and I look at and work
Mhm.
on with clients. Because at the end of the year, clients aren't super excited if they have a huge tax bill, because they'll be coming back to us
Yeah.
asking all about that.
Absolutely. Our slogan is tax wise, money smart, right? There's a reason why tax wise is first. It's very important. It's not just about managing a portfolio for people, it's also about managing their portfolio tax efficiently. And sorry, here I go back to talking about mutual funds again, but you got a $50 billion mutual fund, right? And let's say there's 1 million people that are invested in it. Do you know that every single investor in that mutual fund, their tax situation is going to be exactly the same? Exactly the same. So, isn't it nice to know, and isn't it great to know that you get to look at and talk to the people who are actually making the decisions on your investments, and that they have the ability to make good and sound tax decisions for you and your account? There are many examples of that. One would be, which we were just talking about the other day, tax swaps. A tax swap is a situation where you have, let's say, two companies that are in the same industry. I'll give an example of in the leisure industry, cruise lines, uh, Norwegian Cruise Lines and Carnival. If you look at a stock chart, go back to 2020 uh, during COVID and the pandemic hit, that uh, both of them just got absolutely slammed, right? And recovered from there. Well, if you own one and sold it, you can take the tax loss and then buy the other one, who's going to pretty much continue to follow that other company lockstep, and realize the gains from that company without paying tax on the gain as you hold it again for long-term capital gain purposes, right?
Right.
So it's being able to have control by managing the portfolios in-house that gives us an advantage that the others just quite frankly don't have.
Yeah, I think so too.
Yeah.
And I think I think we've done a pretty good job summarizing all the facets of that advisor-client relationship. Obviously, there's more nuance depending on someone's individual circumstances, and that's the beautiful thing about working with an advisor is it's going to be hard to necessarily find solutions online for your individual situation, just because everyone's financial story is different. And your job, my job,
Yep.
is to make sure that those client goals are translated into investments and financial planning that makes sense for them. And so I think that's the beautiful thing about that relationship. But to kind of close it out on kind of a light note,
Okay.
I think another piece of that relationship is honestly working with somebody that you enjoy to be around, that you
Yeah.
like, that you find personable.
Right.
Jerry, you and I chit chat around the office,
Yes.
on a weekly basis, and I enjoy working with you. But
On
I
a
think
daily
it's
basis.
true on a daily basis, and
We start the day that way.
and I think it's important for clients to get to enjoy that as well. So I think that's
Yes.
something that they should look for. Someone that they, because your financial story is inherently very personal,
Yes.
and so feeling comfortable with somebody that you can share that with, that you can translate your needs, goals, desires to, I think is really valuable.
Yeah.
And I think that that's a big piece of this job as well.
It absolutely is. And, uh, it maybe not like the most exciting thing in the world. You think about, oh, I'm going to see my financial advisor today, but we really try to make it fun and not like you're going to get a root canal. We want to make it enjoyable, and I think we do. We've got just a great staff, and everyone has been there for a long time. I think we've got well over 100 years of experience in our firm, but since I came on board back in '97, Bill's been with us 25 years, Justin Simmons 15 plus, Melanie I know more than 10. Nobody's ever left. Nobody comes to our firm and leaves, because it's such a great place to work, such a great environment, and just a lot of synergy in our firm, and people that love to work together and make it an enjoyable experience for our great clients, many of whom have become really good friends. And you get to, when you work for somebody for 10 or 15 or even 20 years in some cases, you really get to know them and their family and what's important to them, besides how their money is managed. And it's just an experience that I just enjoy coming to work every day for.
Yeah, I think that's awesome.
Yep.
Well, Jerry, I think this was a very exciting podcast. Thank you
Yep.
for coming on for the
Absolutely.
first time. We'll definitely have you back,
Yep.
and I hope our listeners got something out of it as well.
Oh yeah, me too, Victor. Enjoyed it.